Hello and welcome to episode 401 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leakes. Damien, welcome back. How are you doing?
I'm good, Andy. I'm excited to be back after our 400th episode. So we're on our way to the 500th. It's probably going to take us 2 years, but we're determined. But perhaps the most notable thing this week, Andy, that came to light is that we are obviously in sync, and I don't know if it's probably a result of algorithms on social media targeting us, but
Yeah.
we've now developed another obsession independently, which we now have found out we both share. So Andy and I were talking, and we both got bought the same Christmas present over the festive period, and they're basically identical. They're similar. We've both got into Rubik's Cubes. So throwback to our childhoods, we've both got into solving Rubik's Cubes, because now you can get these things called smart Rubik's Cubes, which link up to your phone and an app and actually can teach you how to solve them, and then you can do them quicker and quicker.
Yeah, and we realised this week that while we were super excited that we shared this passion, we shared it in the office, and well, let's just say that the reaction we got was not quite as excited as we'd hoped. And
we
people
were widely mocked, to be honest, Andy, weren't we?
Yeah.
And Harvey actually defended us by saying that we have quite varied interests beyond things that are obviously quite niche, like Rubik's Cubes. But it was one of those things of, could you teach yourself to do something? And I remember as a kid always being fascinated by a Rubik's Cube and its seemingly impossible solution. So without much effort, this taught me how to solve a Rubik's Cube relatively quickly. And Andy and I have been independently, it seems, playing around with it. And so any Rubik's Cube you give to me, I can solve it without any problem. And now we've got to the point that my average time to solve a Rubik's Cube is down to 2 minutes. And in fact, my quickest I've ever done it is 1 minute, 22 seconds. So I've gone from somebody who couldn't even solve a Rubik's Cube now who can regularly, if you give it to me, solve it in 2 minutes. But we almost could do with a drum roll of some kind, because this is where Andy and his slightly obsessive characteristics come into play. Andy is, well, I think he's going to be a speed cuber, because there is actually a new documentary on Netflix about speed cubing. It's a thing we never realised. But Andy, how quickly can you do a Rubik's Cube now?
Looking at my quickest time, which again is one of these things that with the Rubik's Cube, it can be luck sometimes in how the cube sort of presents itself. Certain sort of stages of the cube are already fixed sometimes, just
Stop
by
being
random.
modest, Andy. Just tell everybody.
I think it's 44 seconds is my quickest. My average time now is down to about 1 minute 20. On my last 12 solves, because this app tells you everything, is actually 56 seconds. So I'm regularly now solving in under a minute, which is nice.
And that doesn't sound like a big difference between my fastest and Andy's, but it is light years in terms of solving Rubik's Cube, because it's a big difference, because the process is quite complicated. It's how quickly you can move your hands and all that. Anyway, we're probably boring people senseless, but just before we move on, what is the world record for solving a Rubik's Cube, Andy? It's
somewhere in the region of 3.5 seconds. It's under 4 seconds.
Yeah, so you can just tell that although Andy and I are really impressed, and I never thought I'd be able to ever solve a Rubik's Cube, let alone do it in under 2 minutes. There are people out there who do it in 3 seconds, and there is a program on Netflix that shows you all of this. Anyway, Andy, in light of our achievement, I think people should give us a review on the podcast. 5 stars, not just because we can solve Rubik's Cubes now, but because of all the effort that we put in for doing the podcast. I'm going to tell people what we are going to be doing on the show this week. So we've got the usual 3 pieces. Now, 2 of them are slightly meatier, and the first one I'm going to be talking about is picking funds that have conviction. So if you're going to invest and you're not going to pick index trackers, and you're going to pick funds that you want to try and outperform the market, then some are more likely to outperform and also underperform than others. So I'm going to discuss that topic and how you might find them. And then I'm going to go on and do what is probably referred to as a reaction piece, because Jeremy Hunt, the Chancellor of the Exchequer, did a piece on social media this week. A video went out where he spoke about inflation. So we're going to play that audio clip that he did, and I'm going to react to what he says in that video, because it was very interesting. I do applaud them for doing stuff on social media to talk about inflation, to try and educate people. But I want to use it to try and educate people further because, like a lot of things, there is always a little bit of propaganda in there. So I just want to untangle that and use it as a useful exercise to teach people a little bit more about inflation so they can think for themselves. And the final piece you're going to do, Andy, and it's related to deals.
That's right. It's just a quick reminder. We're in the new year now, and we have got a deals page on the website, which is updated every single day. So I'm just going to highlight that, where you can find it, and actually give out 2 of the best deals for January, because I think a lot of people will be able to take advantage of those. Right. Let's get started then. And it's an investing piece, and it's about conviction, funds with conviction, and how you can spot them.
Yeah, so I've been doing some research for 80/20 investor members that's going to come out in the next week or so. And I know that people may invest in tracker funds. That's one way to invest. They invest passively, so they buy funds that might track particular markets or asset prices. But there's nothing wrong with people choosing to try and invest in funds where they may try to outperform the market. And of course, there's no guarantee that they will outperform the market over the long term, but you are free to move in and out of these funds as you choose. The other thing to bear in mind is there's no one size fits all. So you could invest most of your portfolio passively, but have small satellite pots that you decide to invest in a way that you choose. That may be in funds that are called active funds. So that broad term that means they're run by a fund manager who is trying to outperform the market by investing in assets, for example, company shares that they like, to try and produce returns in excess of what their benchmark achieves. But of course, there are funds out there that are run by fund managers rather than machines, so the active funds rather than the passive ones, that do charge relatively high fees but don't do anything more than just really track the market themselves. So they're almost like closet trackers. So what I wanted to do was talk about, if you want to try and pick a fund that is doing something different, it could be because you're trying to outperform the market. It could be because you have a view that you want to invest in a particular area of the market or a particular technology or a particular sector or something like that. It's your money after all. It's up to you what you choose to do with it. There is no right or wrong answer. Then how would you go about finding a fund that is doing something that's based on true conviction, that isn't a closet tracker, that the fund manager is trying to use their skill to outperform their benchmark, to try and do something different? Because the danger is, if you pick a number of funds within a sector, let's just pick the global sector, so the global equity funds that are out there, there's a sector of all of those funds that try and invest in a range of equities from around the world. There is a point where there is a bit of a herd mentality because they will all have a similar index, a benchmark that they are compared to. So for a fund manager, one way to ensure you keep your job is not to be the outlier. And so if you can be the outlier and you outperform, that's fantastic. You'll probably be paid very well. You have lots of money coming to your fund from investors who want to take advantage of your process. But equally, if you underperform, then you stick out and you're likely to lose your job. So you do tend to get this herd mentality where lots of active funds tend to have asset mixes and portfolios that converge and start to mirror each other a hell of a lot and their benchmark. So every fund will have a benchmark that will be chosen by the fund. It will be stated on the fund fact sheet. So you're looking for a fund that you don't want one that's going to just be the same as the other funds in your portfolio or the same as the benchmark that's out there. How do you find them? Now, one way you can do that is to just look at their performance chart. So call up, for example, on your fund platform that you're using, you could call up a fund that's in, let's use the UK all company sector. So they're funds that invest in UK shares. They tend to be the larger shares in the UK. You may pick a fund that's within that sector and it will have a benchmark. That benchmark could be, for example, the FTSE All Share Index, which is an index that covers the shares that are on the UK stock market. And so they'll be benchmarked against that. Now, if you chart the fund's performance over a period, so it could be 1, 2, 3, 4, 5 years, whatever you choose, and you chart it against its benchmark and its sector average, so the average of its peers in that UK all company sector, you can see how that performance has varied over time. And if a fund is doing something different from the index, then that squiggly line of its performance should be different at times to the benchmark. So it shouldn't track it. It shouldn't move up and down in tandem if you want a fund that is generally doing something different to the benchmark or the rest of its sector peers. But as I say, something different doesn't have to mean something good, because the manager could decide that they're going to invest in a particular company or companies or a particular sector, but they make a bad choice and that underperforms for a period of time, and therefore they underperform their benchmark. Diversification of your portfolio is about trying to pick things that behave in different ways. Now, you could go out there and you could look at funds and look at the ones that are performing and performing well, and you can look at the ones that are performing differently to their benchmark and their sector average. So you know that that fund manager has got it right recently. They probably got it wrong in other times, but they're doing something a little bit different. So you can get an insight that that fund is being actively managed because the fund manager is following their convictions, it seems, because they are performing in a different way to their benchmark, and they're not probably going to be a closet tracker. That is an easy way to compare a fund and come up with shortlists, but you will have to go through each fund on your platform and have a look at them. You may have a shortlist before you start that research process, but that is a visual comparison. It's not mathematical, so that allows a little bit of subjectivity to come in, so you could make a view that may be incorrect. The next thing you could do is you could look at something called tracking error. Now, tracking error is a statistical measure that you might see mentioned on some fact sheets. You might see it on some platforms, but it's not often mentioned on fund platforms, so you might have to dig around to find it. Tracking error is a measure of the difference between a fund's performance and that of its benchmark. So again, pick a fund from the UK all companies sector. Let's just call it Fund A. Then if that fund's performance and its benchmark, let's say in this example is the FTSE All Share, you can look at the absolute difference between its performance over periods of time, and that will be a number, a percentage. That will be a measure of the tracking error. So that is the difference between its performance and that of its benchmark. You can use another measure which starts to be more complicated, and it involves standard deviation, and I'm being honest, you aren't going to be able to work that out easily, but you sometimes see it quoted. The upshot is that the higher this tracking error, the better if you are trying to look for a fund that is generally being managed in line with the convictions of the manager. So the manager is actually doing something. They're trying to be different from the herd. They're following their own convictions. So if you do see that tracking error mentioned anywhere, whether it's on the fund fact sheet, doesn't appear that often. If it's on the platform or some other site you might use for research, have a look at the benchmark they're using, and the higher that tracking error, that might give you an indication that this fund is doing something different. And of course, if that performance has been positive, then obviously whatever they're doing different is working. And when I say the performance has been positive, I'm talking with reference to that benchmark. You can also have that tracking error measured against the sector average as well. So that's the average of its peer group. So the higher that tracking error, that should spark a calls for you to then go and look at the fund fact sheet, go and look at the fund a bit closer and see what they're investing in, and then compare it to what the benchmark is widely invested in. And then you may have found something that is doing something different, and you might then be able to look at not only the individual shares. Don't forget, fund fact sheets don't show you a lot of information about the individual holdings that these funds hold. They tend to only show you the top 10, but they might show you the sectors that they invest in, or the geographical location if we're talking about a fund from, say, the global equity sector. So in the scenario of sector variance, then it could be that they favour things like financials. It could be they favour things like technology. And then you see that that is overweight in that sector versus its benchmark. And you do tend to see that on the fund fact sheets. And then you can see, right, this manager has outperformed, maybe underperformed, because they are actively managing this, and it's based on their conviction because they believe, I'm going to give an example that I make up, that they're overweight in technology stocks. So then you can explain why that fund is performing, and then you can label that fund in your mind or in your research. If you want to back technology, that's the fund to go to look at, or one of them. Now, one thing to bear in mind, just because the tracking error is higher, it doesn't necessarily mean that the fund manager is actively doing something different. They're following their convictions. It could mean that the benchmark that they're using or is used in the research is actually incorrect. It's not the benchmark that the fund is benchmarking itself against when it's being managed. And so that can be something to look into. There are statistical measures that you can use out there. One of them is called R squared, that can give you an indication of whether a benchmark is any good or not. If it's near 1, it is a sign that it is a good benchmark. but we won't get bogged down into that. You just need to be mindful of that. Now I'm going to move on to the final measure I'm going to talk about this week, because it's an interesting piece, this, about looking for funds that could outperform, funds that are actually managed in a way that are doing something different. That's how you can help build a diversified portfolio or follow your own views when investing. I'm probably going to continue this into next week because there's some other ways. There's so much I could have packed into this that I might split it over into next week. So the one final thing I want to talk about is active share. Now, I've talked about just looking at performance, I've talked about tracking error, and now I'm going to talk about active share. And these are progressively harder to find out, generally speaking. But active share is a measure of the disparity between the holdings in a fund or portfolio and the index or benchmark that's associated with it. So I want to give you an example. You're going to have to visualize this. Let's imagine that there was a fund that was invested in just 3 shares, because that's all that existed in the world. There were 3 companies: Company A, Company B, and Company C. They had 80% of their assets in Company A shares, 10% in Company B, and 10% in Company C. That adds up to 100%. The benchmark for that fund only invested in the shares of Company A and B, 50-50. It doesn't invest in the shares of Company C. Now, to work out the active share, what they do is they compare the absolute difference between the holdings in the fund and the benchmark in each of these areas. So in Company A, the fund had invested 80% of assets. The index had only 50% of its assets in there. That's a difference of 30%. Company B shares, the fund had 10%, yet the index has 50%. That's an absolute difference of 40%. So taking those 2 absolute differences, we've got to 70%. This is the methodology. You don't have to make sense of it. This is just the way they work it out. The final share, the fund has 10%, yet the index has nothing invested in it. That's a difference of 10%. Absolute. We're not worried about positive and negative. So you add those numbers up, 30, 40 plus 10, that comes to 80%. And you divide that number by 2, because there's a bit of double counting that goes on when you think about that mathematics. And that gives you a number. And that number, in this case, it's 40%. That is the active share. So it's a measure of that difference. Now, what do you do with that? The higher that number, obviously, the more actively managed it is, because it's deviating from its benchmark or index. So that number can be from 0%, which, if you think about it, in the example I just gave, that would mean it's just mirroring the index. That would be a complete index tracker. If that number you calculate is between 0 and 20%, then it's a passive fund. So it's tracking an index in some way passively. So it's not an absolute mirror of it, but it's passively tracking it. If that number's between 20 and 60%, so I had 40 in my example, then it's probably a closet index tracker, which means there's a manager running it, but it's quite close to the index in terms of its asset mix. And of course, in my example, there are only 3 shares anyway. So you've got to think indices have hundreds of shares in them. If it's a truly actively managed fund that's got conviction in it, then that active share number should be between 60% and 100%. So for a bit of fun, you could go and look at a fund and you can look at its benchmark and you can see the difference, because it sometimes shows you these on the fund fact sheets. And you could come up with an active share number if you wished. Of course, they don't show you all of the holdings on a fund fact sheet. They don't have to. Very rarely do they. I mean, Woodford did, Neil Woodford. And I think one of the problems was he showed everything that he was invested in, and that was used against him ultimately in the collapse of that fund. So generally speaking, they only showed the top 10. But you could come up with a measure there to show how actively that was being managed. Of course, if the holdings are quite small, then it may be that top 10 holdings only account for 20-30% of the fund maybe, which doesn't really give you an indication what the rest is doing and therefore how actively managed it is. But the good news is I did a lot of work hunting around for this, because occasionally you see research published about this. But if you go onto Morningstar and you find a fund you're invested in and you click through to the portfolio page, on there is a statistical measure of active share that they've worked out based on their own methodology. So you can see for any fund now how actively managed it is with this active share measure. Now, that will be complete news to most people who have never heard of this measure. But you can see, therefore, what your funds are like. Go and look at the ones in your pension fund. Go and look at the ones you might have in your ISA and see how actively managed they are. And then you look at how much you're paying for it. You may change your view on whether you want to invest in it or not. The last thing I want to bring in, actually, is that I did once do a piece of research for 80/20 Investor members about correlation between funds. So that is a direct measure of how funds move in terms of performance in relation to each other or their benchmarks. And in the end, the findings were that if you have a number of funds from the same sector, once you start getting above 5 of them, which a lot of people do, then the chances are the funds are going to start doing the same thing because of that herd mentality, because you're more likely picking more of the herd, aren't you? So you're not picking the outliers as such, the ones who are being actively managed. So you would want to keep the number of funds you have between 3 and 5. Now, all of that information I've just given you, those different measures, looking at the charts, if you see a tracking error, great. Active share, you'll find that on Morningstar. You won't find correlations, unfortunately, because they are difficult to calculate. But again, you can find this sort of information on 80/20 Investor. I've done the research in the past. You can take out a free trial if you wish. But you can use those measures in conjunction with each other, because no one measure of anything gives you absolute evidence of whether a fund is being managed or run with conviction, whether that conviction is correct or wrong. If you combine tracking error and active share, that is one way of trying to ascertain the style of management. So if you imagine in your head a set of axes, so going up vertically is active share, and if going from left to right is the tracking error. So the further left you go, the lower the tracking error. The further right you go, the higher the tracking error. When it comes to active share, the higher up the axis you go, the higher the active share is. And you produce that cross. So there's 4 quadrants. It may be hard to visualize, but if the tracking error is low and the active share is high, so it's in the top left quadrant, then that fund is being run in a stock picker way. So someone is picking stocks, shares in there, actively deciding on them, but they're picking a wide range of them. So they're picking quite a diversified selection of companies, but they are different. Their mix is quite different to the index. If the tracking error is low, but the active share is low, then that's the bottom left quadrant. You've got a closet tracker, because they're not doing anything much different to the index, and the fund's performance is basically tracking the index. So you're a closet tracker. And if you're paying a lot of money for that, then you want to reevaluate why you're holding it. Of course, if the active share and the tracking error are both 0, then what you've got there is an absolute tracker. So you've probably got something like some Vanguard fund that's tracking the S&P 500. If you've got a high active share and a high tracking error, so in that top right-hand quadrant, you've got like somebody who's picking stocks, they're picking with conviction, but they're picking a very concentrated portfolio. So they're picking very few companies and they're doing it with conviction. To give you a real life example of that, that would be someone like Terry Smith at Fundsmith Equity. So he doesn't have very many holdings. He has less than 30 in that fund, which he picks based on his own views and his own research, which is very different to the wider index, but he does it with conviction. So he's had periods where he's outperformed over the long term, but he's had periods such as periods last year where he underperformed. And that's because of his conviction-led approach. And then just to finish that off, if you have a high tracking error and a very low active share, then you've got something that is probably a factor-based approach to investing, because the performance can deviate from the index or benchmark, but their active share, so how the individual holdings match up, is quite low. So they're deviating marginally from that index. And so you get this sector bias. So it could be, for example, they're investing in technology stocks, or they have a bit more bias to, say, financials than the wider index does. So taking that all in around, you could use the information to go out there and find funds that are doing things differently and doing them in line with maybe your own views, or you might like the view of the manager. But of course, you can then use that information to understand when a fund isn't working and look at it. It could be because they've got high conviction to defensives and the world is opening up and everyone's very bullish and economies are booming. It could be that they have a high conviction to technology stocks. Well, interest rates have been rising. It's been bad for technology stocks. This sort of information helps you start to understand why funds behave the way they do. And of course, that is part of the reason why fund managers with conviction won't necessarily outperform over the long term, particularly if their reasons for conviction don't vary. So if they always favour a particular style or a particular type of stock, then when that style or type of stock goes out of fashion, growth stocks, for example, doesn't perform as well, then they will underperform. One thing just to close that piece on, it is harder to find active funds, ones that are truly running with conviction, in markets that have quite small selection of stocks. So if you have something like the UK, where there's a very wide selection of company shares you can invest in, that gives managers a much greater choice and therefore much greater ability to deviate from the indices. So if you are going to be looking for funds with conviction, the chances are you're probably more likely to find them in those areas like North American equities, like UK equities, markets that are very established with a large number of companies within them.
Okay, so let's move on to the subject of inflation then. And the Treasury released a video with Jeremy Hunt explaining how inflation works, trying to simplify matters by using coffee cups and coffee as an example. And so, Damien, we're going to play that out now and then we'll hear from you afterwards.
Hi, can I get a flat white, please?
Of course.
While my coffee is being made, let me tell you what we're doing to halve inflation. I'm afraid coffee is getting more expensive. A year ago it would have been around £2.50, but now it's gone up to nearly £3 a cup. And the price of the weekly shop, if you look at food prices, has gone up by about 16%. And for the poorest families, the things they typically buy have gone up by even more. The Bank of England's inflation target is 2%, but currently inflation is about 10%. That means more expensive food, fuel, it means unemployment going up, businesses failing, £1 in your pocket is worth less than it used to be. There are lots of reasons why inflation has risen. One of them is COVID. When we found a vaccine and came out of lockdown, global supply chains struggled to cope, and that pushed prices up. Another is Putin's invasion of Ukraine, which pushed global gas prices to their highest ever levels. And finally, even after gas prices have started to come down, economists say that energy prices will remain high for some time. And all that means that the price of a cup of coffee has gone up. The people who transport the coffee beans over the oceans have to pay more for their fuel. People who transport the coffee beans inside the UK have to pay more. And the result is they have to put up the price of a cup of coffee, otherwise they lose money. So what's the plan to halve inflation? Well, we are investing a lot of money in renewable and nuclear power so that our energy prices aren't at the whim of the international gas markets. We're investing a lot in a national energy efficiency program so we use less energy and help prevent climate change. And we've taken very difficult decisions to balance the nation's books so that markets have confidence and don't punish the UK with higher interest rates that mean families with mortgages have to pay more. And that's what's happening, and that's our plan. Thank you.
Okay, so the first thing to say is that whatever you think of Jeremy Hunt, I do like the idea that the Chancellor is trying to engage on this topic. And now there is a whole political thing in there. There is a bit of propaganda going on. So ignore that and park all your political points to one side. So the narrative that they're trying to engage is about inflation. I think they are trying to control that for their own probable benefit. But it is good that consumers are being spoken to about inflation. The thing is, I want to talk a little bit more to try and take the conversation a bit further, because the danger is that you get pieces like that don't take the opportunity to teach people a bit more and also don't tell you quite all of the facts. Now, in that video, we've put a link in the show notes. It's worth watching it because, to give you the setup, you've probably heard him ask for a flat white, and he's in a coffee shop, and as he's talking about the various things that impact inflation, he's pulling out coffee cups with things written on it like Ukraine war and COVID and stuff like that. So I'll come back to that, but that gives you the setup. One thing about inflation that I think people need to remember, generally speaking, is that inflation is a measure of the rate of change of prices. It's not a measure of how high they are. So the way inflation is calculated is there are a basket of goods that the Office of National Statistics look at, and they compare that basket. It does change, but they compare the changes in prices over time. And one of those measures is they will do it over a 1-year period. So that's why you start to see these measures of inflation like the Consumer Prices Index, which is the CPI. It will take this basket of goods, look at what the value was a year ago, and work out that percentage increase. Now, the reason I mention that it's important is because inflation is running at more than 10% at the moment. So that's saying that in prices, generally speaking, this basket of goods are 10% higher than they were a year before. Now, let's go to extremes. I always think it's great to think in extremes to understand something. If you had a cup of coffee that was £2.50 last year and it cost you £1,000 this year, yeah, your rate of inflation, I can't even bother to work that out. It'll be unbelievable. But if that cup of coffee next year cost £1,000 still, the rate of inflation would have gone from some extortionate, ridiculous rate of inflation to zero because the price hasn't changed. I'm only picking on a cup of coffee. Like I say, it's a basket of goods. So the price of coffee is still £1,000 in that example. So you're still getting high prices. So when inflation starts to fall, it doesn't mean that prices are coming down. So you hear people talk about inflation's falling, yet that means the rate of change in prices isn't as great as it was. So inflation, if it fell from 10% to 8%, that would mean at that point in time, the change in prices is 8% higher than it was at that previous point a year ago. But of course, they are still higher. The other thing to point out that this is a mathematical calculation. So if you have a spike in prices, then what you will see is a rapid spike in inflation. As you move forward, and if prices start to come down, that spike mathematically will eventually not be included in your look back. So therefore, your inflation figure will change dramatically. So if you think about it, with the price spikes we had, particularly around the Ukraine war, and prices have been elevated since, the rate of inflation will start to come down based on mathematics if prices don't continue to go up. They can still be at elevated levels, but because you're comparing it to a period then that's after the Ukraine war where prices are elevated versus today where prices are elevated, the rate of inflation, the rate of change in those prices will be lower. So the reason I mention that is because there is an argument that inflation, the official measure, will start to fall. It doesn't mean your prices are getting cheaper. So when people talk about we're going to bring the rate of inflation down, well, sometimes you could just not do too much and that will happen by a quirk of mathematics. But also, you do have to bear in mind that one argument is that you do have to rein in prices because they could keep going up and up and up forever, which would mean that inflation keeps increasing. You need the prices to level out at some point. And that's obviously where the Bank of England steps in with its monetary policy. It will raise interest rates, for example, and that's to try to stabilise inflation. So I just wanted to point that out because that wasn't really mentioned in there. So you can stand on a video but not mention how they're going to bring it down in excess of what's going to probably happen naturally anyway. So part of it because of a quirk of mathematics. Not guaranteed, but that is a likelihood, and it's the one view. The other thing to point out as well is that the basket of goods is weighted. So certain things in that basket get more weighting than others. So for example, energy and housing costs, or gas and electricity bills, as part of that, they make up about 31% of that basket. And transport costs are about 11% of that basket. So they've driven inflation up. They come down going forward. If they do, then that's going to have a huge impact on what's going to happen to inflation as well. So if we see that happen, and as some people predict that energy prices come down, inflation can still come down even if some of the other things are still going up because it has a bigger weighting in it. So that's again something to bear in mind. It's an important point about this weighting. The other thing is that he used a coffee analogy and used a cup of coffee, and food and non-alcoholic drinks only account for 9% of the weighting in the CPI index. So it's not even the biggest thing he could talk about when he used that inflationary figure. He could have talked about other things and the numbers would have been even scarier. So that's one thing to bear in mind. The other thing is that he does mention, in fairness, that people do experience different rates of inflation. He hints at that. And so if you go back to podcast 384, you can find out how you can go and find out your own rate of inflation if you want to. We talk about it in that episode because Jeremy Hunt doesn't unfortunately tell you to go and work out your own rate. And I'm not really surprised he doesn't ask you to do that. The other thing is he mentions in there as well about the causes of inflation. Now, the danger is he talks about COVID. He talks about Ukraine. He holds up cups with COVID on it and one with Ukraine. But he doesn't hold up a cup that has the word Brexit on it. He doesn't hold up a cup that has the word Rishi Sunak on it. That would be more like a coffee shop, a name actually on the coffee cup. He doesn't hold up one that says Liz Truss. He doesn't hold up one that says, perhaps you could argue, his own name. The thing is that there are certain policies that have been made. For example, COVID, when we had the furlough and the government injected money into the economy through stimulus, that has an inflationary effect. Anytime money floods into our economy, it will tend to have an inflationary effect unless you try and counter it. So that isn't mentioned in there. And perhaps you could argue that that is because they're trying to control the narrative on that. But I just want to mention that because if you only mention some of the causes, you're cherry picking, and there's a danger if you cherry pick, you can slightly mislead. So they should have all been in there for varying degrees. Like I said, the mini budget caused an issue, not just because of the lending issue with gilts that drove up their yield, but because don't forget that our energy price guarantee that we've got now, in the short term, can be inflationary, because what it's done is it's given everybody more money in their pocket. I hate that phrase, but they always use that, the pound in your pocket. Then people are more likely to perhaps spend that. And if you spend that money, then in the long run, that pushes up prices because there's more people trying to buy products, a fixed number of products, and that pushes up prices again. So again, these things in themselves can be inflationary. So you have to bear that in mind. The other thing that I wanted to mention as well is that he talked about the price of fuel and things like that in there. He touched upon it. In the UK, 52.95p per litre on unleaded fuel is actually fuel duty. And that's something that Jeremy Hunt will decide. He has actually cut that by 5p, and there is talk at the moment of trying to extend that 5p discount, because again, that'd be inflationary. If the amount of duty that goes onto fuel increases, that puts up the amount of money that we're paying, and that again will cause a potential inflationary pickup. So on top of that fuel duty, VAT is charged. So VAT is charged on petrol, but it's also charged on the fuel duty, which therefore is basically a double taxation that goes on. So it means overall, if you work it out, about 42% of what you pay at the pumps for unleaded petrol is taxation. So again, that whole rising of prices, the government does have an influence in that. And then actually Jeremy Hunt has a direct influence on that. But again, he won't necessarily mention it. It costs the average household £900 a year. So that's a whole different debate about whether you want to cut fuel duty. But again, it's just giving people information that just blaming the Ukraine war for the cost of something being delivered to you in the UK isn't 100% true. And of course, I did mention QE and stuff. That's the Bank of England with their money printing. Since the financial crisis, that arguably has had some inflationary impact as well. So while I applaud them trying to do a video, it's nice for people to be able to listen to that and then have a bit more information to make up their own minds about whether they achieve the points that they say, because they've listed the points of what they are going to do to bring down inflation, but they don't include some of the things that are going to happen almost by default that are going to aid them along the way. And the other thing is, they don't mention that inflation does actually reduce national debt in real terms. So if you have a debt and inflation is running high, the real value, like they say, the value of the pound in your pocket drops. It does mean also that your debt drops as long as it's not growing. So therefore, if you bring down the real value of debt, that is actually relatively easy if you've got inflation running at a fair pace. So there you go. That's my first ever reactionary piece to something that was done by the government or anybody else. I hope it doesn't put them off doing more. I think they are quite useful to start conversations, but we mustn't let them just finish with whatever is put out by the Chancellor.
Okay, so let's finish off this week's podcast with a very, very quick piece just to remind our listeners to go and check out the Money to the Masses deal page. So I'm going to read out a web address now. It's www.moneytothemasses.com/quick-savings/deals. That is where you're going to find all the latest deals. It's updated daily. We source deals from all over the internet, scour everywhere for you so you don't have to, and we update that page daily. We'll put a link to it, of course, as always, in the show notes as well. I just wanted to highlight two deals that are on there right now. They're going to be available up until towards the end of January. So when this podcast goes out, they'll still be available for at least a week or so. And this just gives you an example of the sort of things you can expect on the deals page. So the first one is free tea and coffee for all January at every Café Rouge between Monday and Friday, 11:30am and 4:30pm. And I'm mentioning that one because I'm actually taking advantage of that offer next week. And so obviously if there's a couple of you, and that's going to save you at least a £5. If you're out and about in a high street and you see a Café Rouge, make sure you get booked in and take advantage of that deal, especially if there's a couple of you. It's going to be worth at least a £5 in free drinks. The other one I wanted to highlight is a free family National Trust pass, and it's worth about £26. You just need to pick up a Daily Mirror between Friday the 20th of January and Friday the 27th of January, and you'll see all the details there and you'll get a free family pass. So it's not strictly free. You do need to buy a paper, but believe me, it's well worth it. And that free pass will cover 2 adults and up to 3 children. So Damien, yeah, the deals page, we love it. We take advantage of it ourselves here in the office. We talk about them daily, and there's always something on there to check out.
One thing I just want to add on the deals, we do try and get deals that are half decent, because I can't stand deals that are really naff. You've got to do lots of convoluted things in order to get them, or there's something you don't really want. So I do look over them and say, look, no, we want something a little bit better than that, because I'm not somebody who's going to be chasing every deal. I really want them to try and be things that people would like to use, like the National Trust, like a Eurostar ticket, something hopefully you would use in the normal course of your life.
So that's it. I think we're done for this week. Let's just do a bit of the admin at the end, as we always do. Please do review the podcast if you can. It helps us to do all those things in the algorithms and the charts, and means that we can help more people. If you've got any ideas on any future podcasts, we're always welcome and open to those. Email myself or Damien. It's damien@moneytothemasses.com, andy@moneytothemasses.com. We've also got the YouTube channel, all of our socials, and of course the Facebook group, which is facebook.com/groups/money to the masses. So that's it. Damien, we're done for this week. Until next time.
So yeah, until next time, Andy.